Welcome to FreightWaves Today. It is Friday, right before a big weekend. Really, we've had a great week here at FreightWaves Today. It's a little bit of summer doldrums, as we're going to talk about today. We did have an earnings report from Volvo. Orders doubled.
Yeah, so I read that truck deliveries were up 6% overall. Net order intake was up 33%, primarily driven by North America, which those orders doubled. Overall, really, I think they beat expectations. They did well. Their net sales were up 7%. Vehicle sales about 6%. Service 7%.
I think the new order number is the more interesting one because it does tell you a lot about sort of the state of the freight market, the fact that we are seeing fleets sort of lean into replacements. A lot of this is replacements. You do have the certainty around the EPA, which I think is certainly going to help, but I don't know that that really creates a big pre-buy. We've talked about the fact that pre-buy is not happening. To the degree that maybe a year ago people expected it would, but I think they were certainly indicating that the U.S., or at least the North American market, is doing much better than even some of their other parts of the world.
Yeah, and we talked a little bit about it yesterday too, but I think consumer sentiment is finally really...
Do you think we have certainty around consumers?
Yeah, so I pulled some stats. We talked about it a little bit yesterday, but the LA port cited specifically for June consumer resilience and that 1 million TEUs, third best ever month at the Port of LA. So they were citing consumer resilience when they talked about that. And then I read an article on consumer confidence. Online sales rose 1.9% in June, which was primarily, I think, probably driven by Amazon Prime Day and some other retailers' deal days. Sports stores were up 1.3%. People were buying stuff. And
the World Cup is helping.
Economic growth rose 5%. But when you back out fuel sales, because fuel fell in June.
Yep.
That was only 0.2%. Did I say 0.5%?
Yeah.
And so it was really 0.7%, which is pretty strong.
Well, that's a month over month. That's month over month. If you look at it over a year, it was something like six and a half.
Because May was up.
Up,
I think a percent or two. But even what I thought was interesting, even car dealers, both service and new sales were up. Almost 2%. Housing still
is that because
weak,
cars,
but appliances and electronics are up. So people are probably buying TVs to watch the World Cup also.
Do you think that the car is really because of all these new models that are out?
Yeah, I think it's summer deals, right? Dealers run huge rebates and incentives to get.
There's also really cool cars that are coming out, like the Scout. I want a Scout.
We've talked about that too. Like, would it be fun to pre-order one? But we don't need any other cars.
No, I don't either.
We don't have any garage space, but it is cool.
There's a lot of really cool vehicles coming out. And I think that may drive consumer desire, if you will. And look, I think the fact that consumers are doing much better, the industrial market's doing better, does tell you. I mean, there was some concern about a year ago. I think real estate's still slow. And I think there's even been some contraction recently in the real estate market, talking to some folks that are in real estate, that they're just not seeing consumer demand for houses.
We had a guest talk about that, last week. Was that earlier this week or last week? I don't know, it runs all together. That demand for real estate is down because people aren't moving, right? Yeah. Even retirees who would usually downsize or move see no reason to do it because their interest rates are locked in so low that even if they were to downsize with a much lower mortgage or with a much lower house, and with a much lower overall house price or value, their mortgage wouldn't go down because their interest rate would be higher. So people aren't moving and making room.
The other thing is like people aren't putting, to the same effect, they're not putting houses on the market, which is because where do you go?
Right.
Like even if you wanted to move, you wouldn't have anywhere to go. Let's get into the headlines.
We kick things off with a major restructuring announcement from one of the nation's largest less-than-truckload carriers. ArcBest announced Thursday it will reduce its workforce by approximately 2%, cutting jobs through employee separations, the elimination of open positions, and attrition. The Fort Smith, Arkansas-based company employs more than 14,000 people. Its LTL business, ABF Freight, operates roughly 240 terminals, and the company will close 10 locations in small markets, rolling those operations into nearby service centers, a change that must be approved by the Teamsters under the National Master Freight Agreement. ArcBest is also retiring its Molo truckload brokerage and Panther Expedite brands, consolidating them under the ArcBest banner and discontinuing its Vox freight movement system to focus on autonomous products. The changes are expected to drive approximately $40 million in annualized cost savings, supporting the profitability targets the company laid out at last September's Investor Day. The move comes just weeks after ArcBest raised its second quarter guidance. Next, we turn to Washington, where a new federal partnership is targeting fraud in commercial driver training. The Department of Homeland Security announced Thursday it is teaming up with the Department of Transportation to investigate fraudulent and illegal practices at commercial driver's license schools, after the Federal Motor Carrier Safety Administration identified approximately 75 entry-level driver training schools suspected of fraudulent activities. Investigators allege some schools used improper driver certifications, falsified training records, and failed to properly train drivers applying for CDLs. Transportation Secretary Sean Duffy said DOT has already removed more than 24,000 drivers who failed English language requirements, while states have canceled more than 28,000 commercial driver's licenses illegally issued to foreign drivers. The Owner-Operator Independent Drivers Association says the investigation is consistent with concerns it has raised for years, calling for regular audits and inspections instead of self-certification, along with a minimum of 30 hours of behind-the-wheel training. Finally, we dig into a sprawling federal case with a direct cargo theft connection. A 28-year-old Texas man, Abdullah Anwar, has been extradited from Qatar to face federal conspiracy charges after allegedly fleeing the country while on pretrial release. FBI Director Kash Patel said investigators targeted transit and cargo theft rings as part of a broader money laundering network linked to more than $1 billion in criminal losses over a 5-year period. Court records reviewed by FreightWaves allege members of the organization identified trailers, containers, warehouses, and distribution centers before coordinating thefts of property moving through interstate commerce, stealing Apple and Samsung electronics, Yeti products, and other consumer goods, then exporting many of them to buyers in the United Arab Emirates and Hong Kong. Prosecutors associated roughly 3,500 devices worth about $1.85 million with businesses connected to Anwar, who remains presumed innocent as his case moves forward in the Eastern District of Texas.
Well, some interesting news related to ArcBest. They have decided to shift the branding of Molo and Panther. Julie, I think this is an interesting sort of pivot in their business model. They paid a lot for Molo a couple of years ago. They've had Panther for, I think, almost 20 years at this point.
Okay.
Yeah, I mean, it's an export business, right?
Yes.
So they've had that, it's the on-demand business and really driven by auto, but I think it's really a sign that ArcBest wants to have a single brand, where it's really bringing it in-house.
Yeah, I think it forces the meshing of cultures a bit as well. When you are all one single brand and you can't call yourself Molo versus ArcBest anymore.
It was a very different culture, Molo's culture versus ArcBest, a legacy union carrier that's been around, well before deregulation. It was built in the 1950s, I believe, and there was an LTL carrier, union carrier as well. There was a conversation when they bought Molo that they were buying it as a defense against the union contract. That was sort of the word. I don't know if that was true or not. But that was sort of an idea that they wanted to diversify their business model for purchase transportation. They were able to get a really nice union contract. Their union contract was up at the same time UPS. UPS got all the attention. Yellow went under. ArcBest benefited from the consolidation as a Teamsters business. That wasn't a contested contract, unlike the sort of issues that happened at even UPS. I think UPS was the sort of the grand prize when it came to the Teamsters contract. Amazon is always the target, but ArcBest was able to work that out. But they bought Molo really at the peak of the market. And of course, the freight market has since collapsed. Any thoughts there on the rebranding?
I think it's also interesting that, and maybe this is through synergy and bringing the brands together, and I don't know what they're doing from relocating and reorganizing, their leadership team and all of those who are running the different business units with the 2% headcount as well as the closing the 10 locations.
Yeah.
So it does feel like they're trying to get more efficient, right, in operating the businesses as one.
10 locations is not, I think, 2% was the headline, was the reduction in staff.
Yeah, 2%.
It's not a big, no. 10 locations isn't a big deal. Everyone's trying to streamline their business. I didn't find that to be a real big deal.
But I think it speaks to hopefully efficiency and the businesses sort of coming in to be one.
Definitely. There's a market, there's an opportunity to do that. Let's bring in Paul Boothe. He is the Chief Commercial Officer, ODW Logistics. He's been around this industry for decades. Was most recently, prior to joining ODW at RXO, you've had some experience working for a big LTL provider that then became a third-party had migrated its business, spun off to become RXO, management its trans. Now you're at ODW. Any take on the ArcBest decision announcements?
Yeah, Craig, thanks for having me. Julie, great to see you again. I do think it's interesting to see, and I think you touched on this, Craig, the merging of the two cultures as they brought MoLo on. You know, going back to my experience at XPO, one of the things that Brad was adamant about was the brand and one brand. You know, you've mentioned Panther now for 20 years. Gosh, it's been that long that they've kind of kept that as a separate identity. Yeah. I do think there's value as you go to customers to be able to speak as one company. And so I think that's probably driving a little bit of what they're doing there with bringing MoLo in and then having now also Panther being part of that, the single ArcBest identity. I just think, you know, from a customer facing standpoint, it's a lot easier to be able to speak about one company offering different products, very similar to what we do at ODW with our legacy contract logistics. And now in 2024, we merged the transportation piece that was referred to as LTS. Now it's not two separate, it's all one. And I assume that that's probably what ArcBest is looking at as well.
The MoLo transaction was always a weird one. Yeah. The cultures just didn't, I mean, knowing both companies and the culture, I mean, MoLo was Chicago freight, like just, you know, freight bro culture. Yeah. ArcBest is a much more southern. It's an Arkansas-based business.
Very traditional.
A little bit more buttoned up, we'll say. More traditional, as you like to say. It was a pre-deregulation LTL provider union. It seemed like a very sort of counter. You wouldn't have expected that, but I think ArcBest was definitely trying to find other services.
Yeah, I agree. I think trying to diversify that, being able to, you know, when LTL is strong, then that provides benefits. When auto is strong, they have the Panther piece. You know, I think you mentioned they bought MoLo at the high, and I think they're probably a little disappointed in how the market had performed since that purchase. But look, things are changed. We're now in kind of this super cycle, as I heard your dad Max refer to it. And, you know, maybe they can catch some tailwind with, and they had an existing brokerage offering prior to the MoLo acquisition.
Yeah, they did.
I think MoLo really just kind of helped solidify that. And
MoLo brought a different culture, too.
Oh, for sure.
Like a completely different business model. And we've seen that happen before, where companies have an LTL or have a freight brokerage business, and they go out and buy a true freight floor, if you will, which is exactly what they got in MoLo.
Yep.
Yeah.
So Paul, you have been around this industry for some time now.
Sure.
You've actually spent some time in the auto space. At Ryder, you went to XPO. Auto is a big piece of it. That expedite business is really what drives the auto market. I would love to get your take on sort of what you're seeing right now.
Yeah, definitely from an automotive standpoint, gosh, if you look at where we came out of COVID and, you know, just the supply and demand and, you know, it really turned the auto industry upside down. I mean, we saw reports of, you know, Ford having thousands of Broncos sitting waiting on chips to be put in place. It is interesting as I listen to y'all talk about some of the indicators and the macro, what's happening in the auto space. There's a lot of new exciting products that are coming on board. We obviously see what's happening with electrification and that piece as well. So I think there's some good things indicating what's happening in the auto space. And look, as we've come out of COVID, supply and inventory has been more balanced. So, you know, it's allowed us to kind of catch our breath from what we experienced in 21 and 22 in that expedite space where, gosh, it seems like the automakers were chartering large airplanes just trying to get parts to keep their manufacturing up and going on.
Yeah, imagine the old NLM business was popping.
That was it.
So that was good. You and I knew each other from Express Direct,
right?
Which was the on-demand business that drove that. You know, this feels like an on-demand market, and it has shifted over the last couple of decades. Now brokers XD was one of the first large national truckload carriers to provide on-demand capacity, that last-minute call. You call as late as you can. We will guarantee you capacity, not guarantee you a rate. We took advantage of the market. Brokers have played in that market. What does the evolution of that look like right now in logistics?
Yeah, I think it's interesting. I mean, obviously, the pendulum has swung and has swung very fast from where we've been the last few years. I'll give you credit. You called the end 3 different times, I think. But
one time, the rest in peace freight recession, I got wrong.
You were right the next time.
Okay.
November, we were right.
I deserve that. We are in a place now where it's very clear the market has recovered.
No doubt. And I think unlike anything that I've seen in my time here, you look at other swings in the cycle that maybe they were weather driven. Katrina was a huge event for those of us 20 years ago that remember that. Now that impacted capacity. But I think what we're seeing now in the marketplace is something that's going to change for the long term. And it's really testing those shippers who have either built a good strategic foundation for how they manage their network, or they've partnered with a strong provider like what we do at ODW to be able to help manage that network on behalf of the shipper.
So I want to talk more about the market, but first I want to change gears a little bit. You took a little hiatus from freight and worked in healthcare. So what made you decide to come back, and what did you learn that you are bringing back with you?
Well, I think you know this, Julie. Once it's in your blood, you kind of grew up with it even as a child with your father. I mean, you can't get it out of your blood. So I had a blast in healthcare. It was my first venture into private equity. Spent some time with a company that had a trucking fleet that supported what they were doing on behalf of their healthcare business. So they were really a lot of smart people who knew a lot about healthcare, a lot about finance, but didn't know a whole lot about trucking. So I was able to come in and make some quick changes there and hopefully make a good impact for where that business is going. But I had a chance to come to ODW, and Troy Tibbetts, who's our group president, had worked with me at XPO, and just in visiting with him and then being able to sit, we're a privately family-owned company, been around for over 50 years, and just understanding the culture as I met with our owner, John Ness, is really appealing, having worked in large corporations, now to be able to come and be a part of a little bit of a different culture, still with that focus on supply chain.
We love the ODW guys. I love working with them. It's a great team. And
it's a fantastic business.
Culture.
I mean,
yeah.
Coming from a big public company, you've worked at big public companies, to a private company that's actually quite big. Not a lot of folks are, because it's not public, you don't have the benefit of Wall Street investors, benefit and curse, we'll say, of Wall Street investors. The problem being a public company is everybody knows when things are challenging, but you also get sort of the credibility and reputation of being a public company. What is it like being at first of all, how big is ODW?
Yeah, so just in terms of statistics, we're about $500 million in revenue. We began in 1971. Bob Ness founded the company on a basis of warehousing and contract logistics. We've got over 9 million square feet across the U.S., across 26 different locations. And then on the transportation side, almost equal in size in terms of revenue to what we do on the contract logistics side. So those two pieces of business, which are now fully integrated, and what we do at ODW, are about equal in size on both the transportation and the warehousing side. We do have a private fleet, or our own asset fleet, of about 100 trucks that we've run. And now that I've come on board and have some experience in the for-hire trucking market, I hope that we can grow that, especially with where the market is going and need for capacity there.
So Paul, what is it like being a part of a big private company? What's the difference between how you guys think about business versus?
Two things I'd point out, Craig. First is we're not making the quarterly chase. We are able to put long strategic planning in place. Our owner, John Ness, and Troy, our group president, have put that plan, and now we can really drive towards that long-term plan is. And we don't have to change just because of how our earnings reports were this quarter and have to completely shift momentum. So it's exciting to kind of be on that strategic growth path and be able to stay on that path. And then the other thing I would just say is culture. Definitely, John's in the office, family owned. You definitely feel, the investment there. I personally feel, only been on board 6 weeks, that I want this company to perform on behalf of his family, and it's a neat place to be.
Is it nice not having the pressure? Because Julie and I both worked for.
Sure.
It was my father's business, but being in a public company. I remember when my dad took US Press public in '94. I was old enough to understand what was happening. I was 15 years old. But I remember, and I was the company's first help desk technician as a teenager, as a nerd. But I remember the shift in the thinking from this long-term thinking that you're as a sort of a member of a family that has this large business, a couple $100 million in those days, to all of a sudden being having public investors that have expectations. And frankly, you can't make decisions without having to deal with the public's opinion. Whether they're investors or not, and just the public comments that you end up getting, Julie.
You're just always thinking about the spin too, right?
How do you sell this to Wall Street? Yeah, I think so.
Yeah, I do think there's a level of scrutiny that comes in a publicly traded company. Hey, everything's under the microscope. You know, you have the investors to please. But I would say there's similarity in that one of the things that I used to say at XPO and RXO is every decision should maximize shareholder value. And I feel the same in what we do here. And that's, we want to be the best on behalf of our employees, on behalf of our customers. We want to be a great place to work. We want to deliver the same service with the similar objectives in mind. But it is a little bit nice not having that necessarily the oversight of,
you only have
what happens with the investors.
You really only have to explain to one set of investors.
That's
which you can get in front of them, explain, they can buy into it. You can also test your idea. Hey, we're going to shift into this market. We're going to make these investments. We're going to shut this down. And you get the reaction before it becomes like, because you only have one audience.
It's easier to get buy-in.
Well, the benefit of ODW, again, is just John and his vision and who he is. He allows the leadership team, just in the short time I've been there, to be able to set that direction and go where we need to go. And so, you know, not all privately held companies may have that type of freedom, but I think ODW is a little bit unique in that who our owner is and how he invests in the team.
We've talked a little bit about the market and how strong it is. So how has that changed your procurement strategy, particularly post-Montgomery?
Oh, yeah. You look at all that's happened in the last 6 months and what a whirlwind it is with Montgomery and carrier strategies. What I would say is for us at ODW, our strategy has not changed a whole lot. We have always focused on having strategic carrier partners that we can rely on. On behalf of our customers, we try and minimize the impact of that pendulum swing. I would say shippers who raced to the bottom for the last 4 years, guess what? They're riding the roller coaster now and they're having it come to the other side. But it's always been my philosophy, and one of the things that I've seen since I've come to ODW is to have strong strategic carrier partners that we take the freight to. We're not trying to drive every nickel out of you when we run a procurement event or a bid event. We're trying to find the best freight on behalf of our carriers. I used to refer to this as reverse sales. We're really taking that freight and selling it to the carriers to try and find the best partnership there. So for us, I would say, Julie, the strategy has not changed a lot. Yes, we have to be conscious of the pockets. We look at SONAR, understand where the heat maps are, understand where we need to potentially take action, do some mini bids. But for those customers who I think have partnered with a strong managed trans provider, hopefully you're a bit insulated in what's happening here. In the summertime, you're able to go on vacation with your family as a shipper, not have to be up late at night wondering if your loads are going to pick up. It's one of the advantages of having a good managed trans partner.
So I'm going to ask, unfortunately, your vacations, when trucks don't show up, get disrupted, but that's what we all sign up for in freight. So Paul, let's talk a little bit about managed tran in a post-Montgomery world, because at least theoretically, at least what we've heard, is that shippers are in some ways on notice of the potential liability that they're accepting when they make direct hiring decisions. There is a belief that plaintiffs' attorneys are going to try to exploit that.
That's right.
Bringing in a managed trans partner gives shippers a level of insulation from plaintiffs' attorneys because they're effectively outsourcing. You guys are indemnifying them from those decisions. How is that changing the conversations with shippers right now?
Yeah, I don't know that insulation would be the word I use, Craig, but I think it gives them a confidence. It gives them someone who they know that's their job. And so if you choose the right managed trans provider post-Montgomery right now, you have that peace of mind of the carrier vetting processes, who's being selected, who those carriers are that are managing your freight. With all the changes in regulation that are happening, you want to make sure that you can go to bed at night, put your head on your pillow, and trust that you're not going to wake up in the morning, you know, with an incident on the news. It doesn't say that accidents still don't happen. Those things will occur, but you want to make sure post-Montgomery as a shipper that you have aligned with the right partner who has the right vetting, the right processes, the right procedures in place to protect your freight. And again, I mentioned it earlier, I think shippers who have chased to the bottom should be a little bit fearful right now of the carriers that you're using, and make sure that they have the right insurance, all the right driver protection, everything that you're using.
I also want to talk a little bit about technology in managed transportation, and you guys have a little bit of a unique offering there, where you really you do more than just 3PL and warehousing. You can really look at an entire network and a supply chain and have a level of visibility and integration that most can't. So can you talk a little bit about technology in your org?
Absolutely, Julie. It's one of the things that drew me to ODW as I began to do some more research and understand what we have. Look, technology has been a buzzword for 20 plus years that we've talked about and what we're doing and how it changes the marketplace. If you go back, it was all about shipment visibility, tracking your loads. Then it became about using technology for your freight procurement. Really, we are now at a place in what ODW offers in our integrated solutions. We can bring everything that happens in the warehouse, from the inventory management to how we pick and pack and ship, to what happens in the transportation planning, all the way even to the network design, working with a customer and what happens there. And so we have a proprietary system, TM Link, that really, you know, we refer to it as our orchestration software, that on behalf of our customers or shippers are able to orchestrate that entire supply chain, all the decision along the way, bring the AI in for continuous improvement. And, you know, it's one of the things that I think really sets us apart.
Have you seen, just in terms of the changes in the market, theft, has it really substantially increased? You guys work a lot in the retail world, which is the most attractive for the thieves. How are you guys managing security inside the business and helping your shippers really control the flow of product?
Yeah, very important. I think beyond just transportation, we partner with our shippers throughout the entire supply chain, from the demand planning to how they're working with their customers, how those orders are generated. You know, unfortunately, there's bad actors out there. We see stories every day. I'm very proud of ODW's record with this. And so what we do, Craig, is from our visibility standpoint, the way we vet our carriers, the carriers that we use on behalf of our customers, and then really just the security that's happening in the warehouse as well, where we have that integrated solution to make sure everything is safe and secure on behalf of the customers. As you said, a lot of the retail product that we move, that's high theft targets, and you know, a lot of good things in place, and happy with where we're going with that.
So what's next in ODW's growth story or growth strategy? What are you looking forward to in the future?
Well, if you look, we've been on an aggressive growth path, and I think I've been brought on board as Chief Commercial Officer to kind of keep that momentum rolling here. I'm really trying to drive what we're doing from a go-to-market standpoint, working with our commercial structure and sales team. You know, I think in the near-term future, we are going to continue to ride this wave of what's happening in the marketplace. We're going to build strategic relationships with our strong existing customers. We're going to expand into some new industry verticals. I think my time at both Ryder and XPO allows us to get there, and keep ODW on your radar. We're a great company, great service, and we're a name you should remember.
Yeah, I think it's great. I got the chance to go visit your offices, beautiful offices. By the way, that place, the Asian bowl place, I still think about that.
Favorite lunch Craig has ever had.
I need to go back to Columbus. By the way, Columbus is one of my favorite cities. It's an absolutely gorgeous and underappreciated city.
I have learned so much about it. I'm in Chicago right now. We're in the process of moving to Columbus later this year. I'm a Longhorn, not a Buckeye, so we're going to see how that mixes there in Ohio. But Columbus is an incredible, incredible city. Lots going on, lots of positive things. The short time I've spent there has been incredible.
And it's the center of a retail. Like, I've always wanted to do an event.
Huge retail.
I want to do an event. Maybe we'll do that.
Come on.
Let's do an event in Columbus. It's such a great city. And I think it's an under radar city.
It is.
It's absolutely gorgeous. It's one of my favorite cities to always visit. I always look forward to it.
I will cater in the Asian bowl place for you.
Let's do it. That's done. We're going to come to Columbus. We got probably retail is fitting. I mean, there's so many of those major sort of specialty retailers, largely because of the old limited brands.
Brands.
You have Victoria's Secret that's headquartered there, limited brands. Other, Gap, I think, has a large operation.
Yeah,
They're
Bath
based
Body
in San
Works,
Francisco,
yeah.
Bath and Body Works. But you have that whole group of major retailers that's right in the heart of Columbus.
Never even knew that. My wife was actually a retail merchandising major in college, and when we began to research Columbus, she brought a magazine to me and go, look at all the retail that's right here. So she was excited about
It's
that.
fantastic. I love Columbus and that Asian bowl place. I still think about it. As I think about it, it's making me hungry here, Paul. Before you go, we always ask for folks that see the market, how long is this cycle going to last?
Oh,
So you get to be on record now, not just me.
let's go. I'm ready. We're in for the long haul. Buckle up. I think with the regulation changes that have happened post-Montgomery, look, supply has been driven out and continues to be driven out. There are some still lagging indicators on the demand side. If we can bring interest rates down, we see housing go back up. Retail has already rebounded. Y'all mentioned automotive. If we can increase the demand with what's already happened with the driving out of the supply in the marketplace, I think we're on a long 4 to 5 year cycle here. So shippers, make sure you're reaching out to good managed trans providers like ODW who can help.
4 to 5 years.
I'm on record.
That's on record. These are long sell cycles like dedicated. Julie, we've talked about that. Managed trans is not something that's made quickly. You've got a long run. If you're right for 4 to 5 years, it can be absolutely chaotic. I think everyone that is certainly on the transportation side is excited to hear that. Shippers are feeling a different world. One last question since we have you in studio. We've talked about this frequently, is that there's this whole turnover of shippers that is taking place. We have a bunch of new leaders inside these shippers. What has that been like? What is your observations, our sort of observations that a lot of shippers just aren't ready or have not seen a carrier's market? How is that shifting the conversations?
Yeah, it is interesting. I've actually said there's a lot of resumes probably being polished up by transportation directors right now. Whatever the budgets were for this year for supply chain and transportation have already probably been thrown out the window. But I think, for those who really understand the strategy, who believe what I just said, that we are in a long cycle, they're looking for partners to help, kind of pull them out right now. I think it's an easy conversation. I've always said when the pendulum swings one way or another, that creates a lot of demand for changes in how shippers are operating. So we're way out here right now. I think there's a lot of conversations happening. We welcome those. And, whether someone has just moved to a new company and they're looking to make their mark and make the change, or they've been there a long time and they need to run a different play, make sure you're finding the right partner who can help support that.
Well, it sounds like, Paul, you've got a couple of years to of hopefully delight for the overall freight market. Our audience will, at least on the carrier side, I'll certainly be happy to hear that. So want to thank you for coming in.
Thank you.
We got to host an event in Columbus. I think a retail event. Bring the Asian bowl place in. Maybe we'll have to bring you guys in for the update.
I would love to. I'm jumping on it as soon as we finish up here today. We'll make it happen.
We'll talk to Jen. We'll get her to schedule this out. Stay with us. We have great conversations. We're going to get into AI and talk about a brand new AI solution released by Pallet. We have the CEO today and founder. Stay with us.
It's National Safety Month, which makes this a great time to ask how your fleet can prevent more accidents. Samsara AI detects risks in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara Complete AI Safety Solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/FreightWaves.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
All right, welcome back. We are going to dive into the SONAR data with Craig's SONAR update.
Well, welcome to the summer doldrums. It's mid-July and things just aren't popping across the freight market. It's not to say things are bad at all. We're at 15.61% in tender rejections. If we think about where that's been historically or has been over the last couple of years, it's still incredibly tight, but not as tight, and momentum has certainly shifted in the market away from carriers having an enormous amount of leverage in the spot market, especially as the tender rejections drop and rates have peaked. We're still above all-time highs of what we started this year at. We're at $3.55 a mile, which is still near an all-time high. Certainly, if it was a year ago, it would have been absolutely astounding, even going back a couple of months ago. But things are cooled a bit, and that shouldn't surprise anyone who's really studied the freight calendar. July is historically a relatively weak time of the year for the overall freight market, as companies like the auto manufacturers shift their product lines and get ready for the new seasons. They actually shut down their factories, as well as other parts of the freight market. This is a time when people are going on vacation, not really consuming physical goods. They're sort of blowing it out. We do see some back to school movement, and really things won't pick up tremendously until we get near Labor Day and Labor Day beyond. So anyone who's been around freight knows that July is just not a great, really robust month in terms of freight demand. But don't read into that. This is not something that suggests that the overall freight market conditions are weakening. We're going to hear from all of the public trucking companies over the next few weeks. And what I expect is going to be very similar to what J.B. Hunt said, is a couple of things. One is a flight to quality. J.B. Hunt talked about how carriers themselves are signing up looking for higher quality brokers because they want to know that they can trust the freight that they get. They want to know that they can get paid. They want to work with high quality providers. The other thing is that shippers are doing the same thing. Shippers are looking for high quality providers. They want to know the broker that's on the other side, or the asset-based carrier that's on the other side, has the balance sheet to protect them, can keep their freight moving, and isn't hiring operators or drivers that are going to get detained. So this is really a quality condition in the market. The fact that we're at 15.61% rejections, and the fact that trucking spot rates are near all-time highs, tells us that this freight market is actually sort of a Goldilocks scenario. It's a fantastic market for asset-based carriers because they are seeing contract rate concessions. And I think this is really what's happening right now in the spot market. Spot market volumes, posted volumes, have been dropping off. Load boards are losing market share. We know this from our channel checks that really companies, particularly higher quality brokers, are not posting as much freight on the load boards. They're putting it into their own networks. They're being required to by their shippers. So if you're dependent upon the load board activity specifically, you're going to find fewer and fewer opportunities. brokers will prefer to use their own capacity networks, and asset-based carriers are getting preference among shippers. Shippers are very worried about combination of capacity and the introduction of liability. Shippers do not want their freight disrupted. They don't want the drivers being detained. They don't want the trucks being shut down. And most of all, they don't want the liability that could come with not properly vetting their vendors. And so they're putting a lot of pressure on brokers to make sure that they're doing business with high quality carriers. And you're not going to find the highest quality carriers on the load boards. This is sort of a known thing. Now, it's not to say that high quality carriers are not on load boards. It just means that on average, the best and highest quality carriers, if you're buying trucks off the spot market, tend to be your own network. You've done business with them, you've vetted them, you know them. When you take capacity off a load board, you don't have the history with those motor carriers, and therefore are exposing yourself to more risk, more chance of freight getting stolen, and more chance of the driver being detained. At least in your own network, you have better controls set up to ensure that that freight can continue to move. And I think shippers know this as well. That's why they're requesting or requiring brokers to only use their internal networks and not post loads out into the ether. We've heard this from a number of brokers that they're seeing this show up in RFPs, is that a mandate that freight is not posted publicly. Or if it is, what is the vetting process? How are you going to ensure my freight moves? And therefore, general loads in the spot market are dropping off. And so it's not something that should surprise us. You have a combination of spot activity, just slow seasonally, and that's certainly showing up. And then brokers are able to find capacity through their own networks, and that's really what is happening. They're not posting as many loads in the open part of the market. And you can see this in the overall data. So spot rates have cooled off a bit, but we're still near all-time highs. Tender rejections have cooled off from 17.5 to 15.6, but we're still near new cycle highs. And you can see it in the haul map. A little bit more red. Blue is good. That means for motor carriers, blue is good. These are outbound markets. Freight is hotter. Go blue to blue is what we say if you want to keep your trucks running. Blue, there's less blue on the map, there's more red. What does that mean? It means that there is more trucks going into markets than there are loads in those red markets. The blue markets are getting much more concentrated, particularly on the eastern side of the United States. And this, again, is reinforced by J.B. Hunt's earnings call. They talked about the fact that their intermodal business is seeing more activity, perhaps unusually, or certainly not a pattern that they've historically seen, in the eastern half of the United States. Combination of tight capacity, a pretty substantial intermodal to trucking spread of 34%, and just the fact that they can't find drivers in these markets. Either direct recruiting is difficult, or there just isn't enough capacity. And so that is driving a lot of it, combined with some reindustrialization activity that's happening in the old Rust Belt. This is a market that's really a carrier's market. Now, things are definitely a little softer, but it's not to suggest that contract rates aren't going to continue to move up. We are projecting double-digit contract rate increases between now and next year. And the reason we project that out is that demand is picking up in certain quarters. If we take out the calendar seasonality, we do see higher demand, and you're seeing it in sort of higher economic activity. The consumer is not rolling over, unlike some expectations, even with higher fuel prices. Inflation looks like it's coming down, and the industrial activity is heating. So take the calendar away, take the seasonality away, and pay attention to the broader signals. Higher industrial activity, good consumer activity, tighter capacity. And shippers are now aware of how tight freight markets are. That means contract rates are coming into force. And so I think what we're also seeing is that more freight is showing up in the contracted market and is not hitting the spot market because it's being given to the asset-based carriers. They're agreeing to higher rates, the shippers are, and therefore carriers are honoring those higher rates by providing capacity. And that is why the spot market is not as tight this month. Seasonality combined with shipper direct to carrier commitments and reconfiguration of the routing guide. Carriers have gotten higher rate concessions. You can see it in the contract rates. And therefore, the need to buy as much on the spot market just doesn't exist. So, Julie, I think my whole message is, hey, a little bit of softness or a little bit of easing in capacity, but nothing to be worried about. We've talked about just how strong the market is.
Yeah,
July.
This is normal seasonality. For us to expect that there's not going to be any seasonality, even in a tight market, would be insane.
I mean, beverages are an exception, but this is the time of year, that July is just not a great month.
Yep.
Great.
But I mean, tender rejections are still above 15%. That is not a weak market. It's like, I heard an analogy when you walk outside and it's March 1st and it's 65 degrees, you're like, oh, it's gorgeous. It's wonderful.
If it was 65 today,
and then you walk outside in July and it's 65 degrees and you're like, oh my God, it's freezing.
so cold.
Right? So it's a little bit of what you're used to. Like compared to where we've come, 15% is huge. Maybe not compared to a month ago.
Right.
And so it's really all about that frame of reference. And I think that you're right in that it could be kind of a Goldilocks moment for the rest of the summer where hopefully brokers get a little bit of relief, more freight is shifting into contract pricing, shippers are waking up and allowing for those rate increases to happen.
I was talking to a large broker yesterday that was talking about the fact that their margins were something like $400 per load, which is a huge number in terms of transactional margins or margins per transaction. That's a big number compared to, most of the time it's $100 to $150 in margin. I mean, you're talking about an expansion, but that is because I think you're getting these higher contract rate increases are coming into effect. I mean, it's one of the interesting thing taken from J.B. Hunt's earnings is that we talked about this yesterday, is that brokerage was certainly one of the weaker parts of their business model, but I think brokerage for them really helps them serve a lot of their customers as sort of a single source. What do you expect to see from some of the other public brokers?
I think it's still been tight, right? A turning market is tight, right? You've got to wait for that's when you can either make the most margin because you're playing that gap.
And getting those spot market opportunities.
Down, right? As it's going up, it depends on how quickly you can shift in the spot market and how you can then, procure that capacity. So I think there was still a ton of pressure on brokers.
And I think a lot of shippers.
And they had to also look at their procurement strategies and the post-Montgomery world and probably review a lot of their processes.
Yeah, I think also shippers are certainly understanding the pressure. Their routing guides, I think larger asset carriers are getting rate increases, and it's causing shippers to revisit who they're doing business with. Some asset carriers are not showing up the way that they did before, so it's created a lot of pressure. There's still going to be those on-demand opportunities. RXO would like to remind you that they are capacity now if you need it. If your routing guide breaks, RXO is there. Let's get to our next guest. I was with him this weekend. We went to the World Cup. Had a great time. We saw the UK, or I should say the England versus Norway. Had a fantastic time. By the way, I think the Norwegians win in terms of best cultural experience. At least that's my observation. Maybe the highest brand rise of American consciousness. Sushanth, welcome to FreightWaves Today. Welcome back. This is your second time on the show. You may be our first repeat guest, by the way. Doesn't work here at FreightWaves.
I'm glad that I'm excited that I'm the first repeat guest. It's great to be back on here, and it was great spending this weekend with you at the World Cup.
It was amazing. Thank you for hosting. It was awesome to spend. And just the folks that were also in the room representing some of the largest logistics operators that frankly have been using Pallet, have been taking advantage of what you guys have been building to really create AI enablement across their business. It was really awesome to see and have conversations, as we were watching the game and elsewise, about what they're doing with Pallet and how successful and really the successful implementations that they're experiencing.
Yeah, I mean, I think part of it is one of the things we really think about is that when you're operating one of these companies, you really need a provider that considers everything from you, from cost, data privacy, accuracy, and a lot of the folks in the room we're fortunate to be working with them, and we're glad we're able to deliver experiences with them that actually deliver ROI back to their businesses.
Yeah, it's awesome. Well, you guys have a big announcement. You've announced yesterday that you've rolled out this custom model. For those that aren't familiar with what that means, we'd love for you to describe it.
So yeah, basically custom models we have a belief in the role that every company, every freight brokerage, every carrier, every BCO is going to end up with their own model. Basically, we believe in the concept of sovereign AI. And why does that matter, right? The question is like, why go to that world versus everyone just using Gemini, Anthropic, and OpenAI? Well, the reason is a couple-fold. The first is data privacy, where one of the things that large enterprises are starting to care about is I spent all these years accumulating all this institutional knowledge. Why would I go and give that to one of the labs and lose all those proprietary insights? The second is really cost, where done right, your own model allows you to have way lower costs per transaction than anything else. And the third is we've actually noticed that the speed of processing a load tender, a quote, an invoice is way faster with these with your own proprietary models. So what we at Pallet want to do is we want to be that provider that allows every company to be able to take all their data, customize their own model, and that is their model to then go and utilize. So they have full control over their AI strategy from the model and hardware layer all the way up to the execution layer. And that gives them basically independence from the labs, where they can control their most proprietary data and they have their own models to go and power all of their workflows.
So you talked about it, being able to help cut costs. Can you talk a little bit more about that? How does it actually cut costs? And then expand a little bit more on how it also increases speed.
Yeah. So the way it cut costs is if you think about if you're talking about one of the models built by the labs, they actually don't have a lot of logistics specific context, right? Like they don't know the concept of how are your LTL tariffs structured. They don't know what your shipper relationships are like. They don't understand your routing guides. There's like a lot of context that these models just don't have about the industry. They're trained on open internet data. So what we find is that these models need a lot of context to be fed in. And as a result, the transaction costs are a lot higher because they're built for very general use cases. But when you take a specific model that was just trained on your data, and that's your model, it's very specialized to be successful in logistics use cases, things like load tender processing, quoting, invoice audit, scheduling, handling your routing guides. And it's because it's been trained on that data. So it's able to be a lot more efficient on a per transaction basis. It would be like the equivalent of having a general purpose smart human like processing a load tender versus someone who's been in the industry processing a load tender. The person in the industry can just do it faster. So as a result, these models consume a lot less tokens and they're far cheaper per transaction. So when you look at the cost of processing a quote from let's say an OpenAI model, it might be 50 cents versus the cost of processing a quote from a purpose-built model that was trained on your data, it might be 13 cents. So as a result, you're seeing a 70 to 80% cost reduction on every transaction call. Because what's different with AI is that you have these per transaction costs. And what we notice is that the per transaction costs on models that are trained on your own data, your own models are far cheaper than using one of these frontier models.
Sushanth, I know that just who was hanging out with us in Miami was a lot of international companies, a lot of firms that have international exposure, international forwarding, international warehousing and operations. Is that a reflection of the types of customers that Pallet's working with, or is that just a very small sample size that suggested that that there's a much broader set of customers?
There were a lot of international customers. Pallet has both a pretty large base of domestic customers, as well as we're fortunate to be working with some of the international players like, Paul Swinland and Mallory Alexander and some of the others that were in the room the other day. I would say that we have a very large customer base that spreads domestic and international. And what we've noticed is sometimes when we're going and working with these international providers, like we were talking to a large global 200 enterprise that does over 50 billion of revenue. I was talking to their chairman a few days ago, and he was like, we don't want to work with the American frontier models. So the only reason we'd consider working with Pallet is that you guys help us deploy our own model and have control of data end to end because of geopolitical tension. So what we found interesting was had we not had this offering, some of these European corporations wouldn't even want to work with us.
Well, that is definitely a European statement to say that we don't want to work with the American models. Data security, GDPR tormented all these media companies and elsewhere. So that's no surprise there. Will you be taking advantage of some? I mean, some of these Chinese models are incredibly cheap and they're quite good from my understanding. Is there, for just a cost saving standpoint, do you think you take advantage of some of the models that are coming out of China?
Yeah, we do take advantage of the models coming out of China. We disclose to our customers that, hey, we're using Chinese open source models in certain cases, but you may make the decision to not want to use that. You might want to prefer sticking with Llama or the open weight models based out of America. The Chinese open source models are leading, like they're sort of some of the leading players in sort of the open weight space. And what we do is we basically help clients take those, host those within their own infrastructure and fine tune them. So definitely utilize them, definitely disclose those to our customers. And in cases where customers are not comfortable, we give them the choice to pick whatever open weight model they want. If there's a strict preference for using Mistral in Europe or Llama in the US, we want to make sure that the customer is in full control of which open source models to go and use.
What is the real value here? Is it cost savings? Are certain models better at handling different types of applications? You've talked about training models specific to these use cases. That makes sense. But is there also some element where certain models are more efficient than others at handling certain tasks?
Certain model, I think what's happened is basically a lot of there's a question about model power. Like if you think of Anthropic's latest Fable model, there's a lot of complaints about it's very powerful, but how cost inefficient it is. Whereas if you take a look at Kimi or Qwen or DeepSeek, these models are far more cost efficient versus using the latest Anthropic or OpenAI models. So what we find with model routing is it's very easy to end up, like let's say you're processing a quote. If you push the most frontier model, the cost difference is pretty significant where you might be like, this costs more than my human operators doing the task. So there's no point of utilizing AI. Versus some of these open source models, like it actually makes the cost like dramatically cheaper. So we actually view a huge portion of having a successful AI strategy is knowing how do you match the right kind of performance and efficiency of a model to the right task. And if you don't do that, you might just end up with a bill where the ROI for your business is non-existent.
I mean, one of the things that we talked about over the weekend was just the fact that, people are vibe coding and sort of doing some of this stuff themselves. And then there's this concern about whether they're really understand the cost that they're implementing, the human cost of replacing, getting, building something successful, having to maintain it as it goes forward, versus using someone like Pallet that's always looking at these different models on a consistent basis, understanding which ones are more efficient than others, and looking at different use cases and best practices. How do you view the market in terms of those that are sort of just vibe coding, and where do you think the opportunity is for someone like Pallet to be introduced into the business?
I think that the opportunity for Pallet is like there's a couple fold. One is the cost of productionizing. It's really fast to get something vibe coded that looks good on paper on just surface level, but it's really hard to productionize something. So in order to get something like a 99% accuracy, which I argue you need for things like processing your load tenders, handling your invoices, that takes a lot of time, and companies need fast time to value. The second thing is a cost. Because Pallet has optimized which model to pick for the right tasks, we can often be cheaper on a per transaction basis than building in-house, because folks in-house might not optimize every single use case to the right model, versus we've built expertise around that. And the third part is that folks forget is that there's an ongoing cost of maintenance. Your business is dynamic and it's constantly changing. So it's not like you build it once and you're done. You have new customers that you're onboarding. You have new carriers you're onboarding. You have new lanes you're handling. And every time that stuff changes, you have to go and update your AI agents to go and handle that new context. And that also takes more cost. So when you think about time to value, you think about cost per transaction, you think about ongoing cost of maintenance, there is a huge gap between buying and building. And I think that's what folks often underestimate, which is why, as you've known, some of the largest public companies still prefer to go with companies like Pallet, because they realize that there's a lot to kind of successfully deploying and maintaining these AI agents.
I also imagine that data privacy and data ownership plays a role in some of that. So can you talk a little bit about why data ownership matters so much specifically in supply chain?
Data ownership matters a lot in supply chain because whatever provider you work with, like let's say that you're a leading LTL carrier, you've accumulated all of this institutional knowledge over decades, right? And what you don't want to happen is you don't want to hand over all your data to a vendor and then they go and they share these insights and now it's available in the model for all of your competitors to go and utilize. You want to have control over all of that proprietary knowledge about your rates, your routing, your secret sauce. Your secret sauce has to basically be contained to yourself. So at Pallet, we isolate everything from the data to the configuration. We have a data retention policy where all the data expires that we're running through our agent traces in a certain time window. So the customers control the data and all of their data is isolated and it's fully under their control. So that way they can control their secret sauce and their proprietary insights they've accumulated over decades. Versus when you hand all of that over to a frontier lab, you might just be handing all of your insights to your competitors and you don't know how they're going to utilize that data.
Sushanth, the word custom models makes me feel like this is customized for me. Is that really the idea when you describe custom models, what the purpose is?
Yeah, it is customized just for your business and your business only. So what we do is we basically help you take all of the data in your business, structure it in a way that could be utilized for model training, train the model specifically for you. We have best practices on how to do that, make sure its performance is reliable, and we give that model back to you. So that model is fully yours, and it is only trained on your institutional data. So that way you're confident that no one else has access to it. You have full control over it. And then every time your business evolves, we help with retraining it, adapting it, so it has new context fed into it. So this is literally, think of it as a model for every freight broker, for every LTL carrier, for every warehousing company has their own model that they have full control over.
I would argue that this is a routing guide, but for AI. That's really, when I hear it, it's like, how do you route the transactions to these different models to take advantage of whatever you're trying to accomplish? This is just tactical, least cost. This needs a much more complicated level of processing and decision-making. And so I think the way I think of it is really this idea that this is a routing guide for AI specific to you. And we just had a major lightning. I don't know if the power didn't go out, but something just got struck outside. So good job to the production team. South is excited we didn't lose power. You guys didn't hear it, but we just had a major lightning storm. So anyways, Sushanth, I've heard through the grapevine that you guys are, at least our channel checks tell us that you're the most successful AI native company in logistics. What do you attribute that to?
I think a huge portion of that is really a focus on ROI. Like everything from this company, from really how we do our deployments to how we price, is all about helping companies improve margin, improve service, and we're very maniacal about that, right? I think there was one of the customers at the World Cup might have told you, our team literally flew to Poland to understand how their employees are doing work. Our engineers went there, studied everything, brought back a very personalized agent based on that experience, made sure that the agent actually worked reliably with all their tribal knowledge context and achieve full-scale automation so it could free up everyone's time and allow them to focus on revenue-generating activities. And that company has experienced very significant EBITDA gains. We're not just coming here and deploying a fancy tool or a vibe-coded app for the sake of deploying AI. Everything has a maniacal focus on ROI. So when clients use Pallet, they can be like, this is actually an accelerant for me to achieve my targets. So they're actually, the thing that people walk away with is this is AI that delivers ROI. And there's a maniacal focus on deployment quality. And I think that that's what's driving that success today is that everyone walks away and they're like, if you pick Pallet, you have an AI solution that really drives ROI back into the business. It's not just another fancy AI application that just does cool voice calls or shows a fancy demo. It is a solution that delivers ROI.
Yeah, this is absolutely an incredibly exciting and cool new product release, but I have to ask, what's next on the product roadmap?
What's next on the product roadmap is we're focusing a lot on use cases that help our clients drive revenue. So everything from how do we help you look at all these signals within your business to be able to help you identify insights on which of your customers are highest likely to churn, which of your customers are experiencing significant margin growth that are likely candidates for cross-selling. We're helping companies deploy revenue agents based on certain intent signals, like, hey, certain patterns about your shippers have changed. Now is probably a good time to have your sales reps go and outreach. So we're really focusing on building a full-scale suite of agents that help drive revenue, because we want to be the platform that not only helps you improve operational efficiency, but that ultimately can accelerate your top line. And that's been a huge focus of what we're doing next.
Well, Sushanth, I got to ask the most important question. Who's going to win, Argentina, Spain? Who you got?
I'm pretty big on Team Argentina. I have never seen a team with so much of a clutch factor this World Cup, where whether you look at Cape Verde, Switzerland, England, just the mentality they have in minute 80, it's like unprecedented in World Cup history. There's never been a team in like over 50 years that's been able to pull off the type of comebacks they have. They just seem like they're in prime time. They have the mentality, and never bet against Messi.
What is the score? Do you have a sense on where this will end up? A prediction?
I think it's 2-1 or 3-2 going into overtime.
What do you think, Julie?
Well, I know what I want to root for Spain. I would like,
because they were a
Spain to
local,
win.
they're our local Chattanooga adoptee team.
The score will probably be 2-3, one way or the other.
2-3, we'll see. Well, Sushanth,
It's been great.
best of luck with the new model, custom models you can get through Pallet. Appreciate you coming on. We'll see where the game ends up. It's this weekend.
Wow. Yeah.
Of course, see y'all.
I think this is another example of what we talked about of being able to integrate like less need for software, right? Like data, you need an opportunity. Like I can imagine sitting at your desk and asking the questions for everything you do in your workflow here and having it do it for you versus.
Or you need the experts.
Versus pouring through. You need the experts to ask the right questions to make sure answers are right, but versus, pouring through load by load and doing all this. I think it's a cool opportunity.
Good team, by the way. I enjoyed my time. We'll be right back with Freight Expectations and the one and only attorney that doesn't charge you, Matt Leffler. Stay with us.
In today's supply chain, every mile and every minute matters. Shippers, lessors, and railroads count on performance they can trust. That's where Trinity Rail delivers. With integrated railcar solutions including manufacturing, maintenance, parts, fleet management, and leasing, helping you reduce downtime, optimize your fleet, and stay ahead of demand. Because efficiency isn't a goal, it's a competitive edge. Trinity Rail, built to deliver.
Trailer leasing can help you stay ready. With more than 70,000 trailers and over 40,000, trailers with 40 locations nationwide, Premier gives businesses flexible access to dry vans, reefers, flatbeds, and chassis when plans change. They're known for transparent pricing, quality equipment, and 24/7 in-house road care support. So you can get more than just trailers. You can get a partner that helps with your operation and keeping it moving. Visit them right now at premiertrailerleasing.com to get set up before your next big surge.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Welcome to Freight Expectations. You've been clamoring for it all week.
They've been screaming, clamoring, banging on the doors. Craig, we have to give them what they demand, and that is more freight expectations.
It is, there's so much going on, Matt, as there always is. A chance for you and I to dive into it. A lot of just big announcements, geopolitics, this Hormuz seems like it's not ending. The Iranian conflict seems like it's going to be there. But IEEPA tariffs sort of bringing back a conversation that really, I think, prompted us to start the show is the idea of tariffs and IEEPA tariff refunds. I guess from the federal government's perspective, successful because they've held on to more money. We're only talking something like $86 billion, something like 20% of the total money's been refunded. What is your read on this?
Yeah, this is where we first began doing Freight Expectations, Craig. We were diving into the IEEPA tariffs, the International Economic Emergency Powers Act of 1977. IEEPA, fun to say, even more fun to explain. And as we covered this case, we watched it go to the United States Supreme Court, where the Trump administration had lost at every single court, the Court of International Trade, the Federal Appellate Court, and then they get to the Supreme Court of the United States. And over the course of the time of IEEPA tariffs being collected, again, it had never been used the way that it was used in this particular circumstance. And so many people went in thinking, okay, IEEPA tariffs are going to get knocked down. We didn't know how much money had been collected. We still have probably 160 billion or 166 billion, some big number with a B. But ultimately, when the case was decided, you and I broke it. We covered it. We've written and talked about this case. I believe it is one of the most important Supreme Court cases in my lifetime. And I suspect in many of our viewers and listeners' lifetimes, this case was incredibly important. So far, about $77 billion or $71 billion have been returned to the taxpayers who paid these taxes, the actual importers. In the month of June alone, it was like $49.2 billion was returned, not to the American consumers. That went to the forwarders who I suspect will trickle those savings down. But yeah, we're starting to watch this thing get kind of refunded. And even the Trump administration, during the initial oral arguments, they made the case that it's going to be really difficult, really hard to refund this money. It apparently isn't nearly as difficult as we had expected, and there's still a lot more to be done. But we are watching this thing happen in real time, and a lot of the taxpayers who paid those illegal tariffs are going to get their money back with interest, and that's $166 billion or so that will go back to the American economy.
Yeah, my numbers were wrong. I was looking at the total tariff numbers, 166, you're right. So half the money's been returned. There's a window, though, to get refunds. If you don't file for your refund, you may not get it. What is an importer doing?
Yeah, so there's a website you can go to called Case. We can put a link in the show notes. I'll send it to Isaiah. They can kind of promote this. Your 3PLs, your freight forwarders, they know this. This is why you paid them money to help you, because they understand how the taxes and the tariffs change. And even though IEEPA tariffs might be gone for now, there's still a whole gaggle of other tariffs that people still have to deal with. I wrote them down: the 122s, the 232s, the 301s. I am by no means a tariff expert. We should probably get our mutual friend, Dr. Jason Miller, back to talk about what the impact will ultimately be. But yeah, there's a lot of money to be had, and if you miss your window, you might not get that money back. A lot of people have come to me and said, "Hey, Matt, I'm a consumer. I've bought a lot of stuff. Can I get some money back?" And let me be very clear. There's no money for you. There is no money for you. You didn't pay the tariff. The importer paid the tariff. You paid maybe a higher price, maybe you didn't, but you are not getting any money.
But that's not true necessarily, because I did get something. I bought something online. It was a part for my airplane. It was a tow. The part was something like $300. But I bought it directly from a company that was based in Czechoslovakia. And I got a notice from DHL that my part was sitting in a warehouse, probably in Ohio is my guess, where I couldn't get it until I paid the tariff. I had to pay it. I paid it through DHL. So I did pay the tariff. Now, I think what you're talking about is if you went and bought something from Walmart or Amazon online, there's a tariff associated with that. That's where you didn't pay it directly. The importer did. You're not going to see those refunds. But in a case where I actually paid I think it was a $56 tariff, I want my money back, but I'm not going to spend the effort to actually go do that.
Well, so here's what I'm gonna push back on you, Craig. I'm gonna push back. think you need to do this. I think you need to bird dog this thing all the way to get your money back, because Craig, I want to help you get your money back. Like, I want that money for you. And I think it's
$60 though, it's an effort. I don't know that I care.
Your audience would care to see how the sausage is made. There's a fascination with this kind of stuff. I mean, a lot of people say, I want my thing back. I've paid this thing. You have a claim. We can help you get that money back.
All right, so what is the process? How painful? Like I said, it's $60. These days, that buys you a dinner, maybe like for yourself. You go out to eat.
I got some friends at DHL. I suspect you might have some friends at DHL too.
But calling in favors for a $60 tariff isn't my issue. But so as a consumer, who do I go to? The DHL has not sent out a notice that I can go. Why would they, right?
Yeah.
I'm sure there's a website. I'm sure on the website I can go look it up. But again, what should I do?
Yeah, so with DHL specifically, they actually have been tracking what they've paid on behalf of their customers for these tariffs. So if you had to pay that directly, there's a way that I almost am certain they have already filed for their reimbursements and likely will send out refunds. For most freight forwarders or importers, there's a website the government stood up where you can put your claims through. And I mean, it's been moving a lot faster than people anticipated. I mean, the fact that we've done like almost $50 billion in refunds in June alone shows that the government understands who paid these tariffs, and the importers certainly know how to go about those. I will have to dig a little bit deeper for individual cases, because if you paid that through DHL, they're likely going to seek reimbursement on your behalf, and I suspect they'll have some information. But I'm actually going to follow up with some of my buddies over there just to see, maybe not for you specifically, but just for people who've had to do these things, what the pathway has been to recover them. But what the government has really said to everybody is, if you have a claim, you got to file it in this website, and if you don't do it by this timeline, you might lose out on that money. So we've seen a lot of people start this. It's also helpful to know, like, even before IEEPA was ruled unconstitutional, the tariffs associated with this, many big retailers already sued the federal government in the Court of International Trade, which is a U.S. Federal court, to recover money the moment those tariffs were first announced. So there's like over 2,000 cases of people who have litigated against the government trying to get their money back. But now the government has built a portal. It has far more successful, I think, than Modus has been, just because they stood this up pretty rapidly. But yeah, there's a pathway, and you got to follow it. And if you don't, you might lose out on that money.
So Matt, do we think that we're done with the tariff noise? I mean, USMCA, like, who knows where that's going to end up? The Trump administration is refusing to renew it. They want the ability to negotiate this stuff on a continuous basis. Not sure that helps the companies that rely on USMCA. I don't think it solves anything for them, but certainly gives leverage to not only this administration, but future administrations in terms of leveraging that. But are we done with the tariff noise? It feels as if the president's moved on to fighting wars versus fighting trade wars.
This is a fascinating moment in American history. I couldn't agree with you more. The recent noise and talking has not been a focus on tariffs, but I'll be very clear. The Trump administration really likes the tariff policy. They like the idea, and again, they don't characterize it as a tax on the importer of record, but that's what it is. A tariff is a tax. A tariff is a tax. And for those in the back, let me be very clear. A tariff is a tax. But ultimately, they're going to continue to use these levers in negotiations for trade deals. That's part of the reason they used IEEPA initially. These other ones have restrictions. They're not as flexible. They're much more rigid in their application. But there's no doubt that the Trump administration will continue to use tariffs as one of the tools in the toolbox. This ongoing conflict with Iran. And man, like, you and I have been talking about this since the very first day this conflict started. We have Sal Mercogliano to come talk to us about the Strait of Hormuz. And most Americans didn't even know what the Strait of Hormuz was 6 months ago. But now you can't go a day without getting updates on the straits. And this is a catastrophic event. The memorandum of understanding, which again we covered and discussed, is out the window. And now we have a conflict that is escalating every single day. God forbid we have troops or boots on the ground, but who knows what the future holds. But this is the thing that I think many people in supply chain are, for very good reason, concerned about. So much diesel, so much of the urea, so much nitrous, so much comes out of that strait that it is almost incomprehensible about how massive this problem could ultimately be in the months ahead if this thing does not get resolved in some meaningful way soon.
But Matt, it's for the rest of the world. Like, America benefits. We've talked about this. Look, inflation dropped. Even like when energy dropped, inflation dropped, but we're not seeing runaway inflation, with the exception of energy's volatility. Like the U.S. economy's held in, consumer activity's been strong. We've covered it frequently over the last couple of days, just retail sales. And industrials is doing well. Like, there is no reason to get, there's been this alarmness that you have talked about. I think you were more worried about the economy than I was a couple of months ago because of this Hormuz and Iranian situation. It hasn't had an impact. In fact, I've argued that this is a stimulant for the U.S. economy. And certainly if you're in freight, there's no reason to be concerned. Industrials are doing well. Like, at the end of the day, there's a lot of noise, and yes, if you're in the UK and you run out of jet fuel, or you're in Australia and you're running out of diesel, a lot of these are policy decisions that they did it themselves, not necessarily. I mean, when you build your supply chain to be reliant upon a part of the world that is subject to these types of disruptions, and it shouldn't be news to anyone that the Middle East, particularly with Iran, is a very kinetic place. I mean, if you go back and look at American wars over the last 60 years, really since the British colonized the Middle East, we've been in the Middle East. American and British and Western troops have been in the Middle East that entire time. There have been kinetic conflicts in that region for centuries, but certainly since America is the one remaining superpower. Why would you depend on your supply chain, in terms of energy supply chain, fertilizer supply chain, to be dependent upon it? Like, I get that this is a crisis, oftentimes not of the people's making that are subject to it, and it's a travesty. But the problem is NIMBYism. The problem is anti-carbon. The problem is anti-fracking. Australia has massive shale reserves, but they've outlawed fracking in places where nobody lives because the kangaroos will get upset. Or
those are
spiders.
Vicious animals. Vicious.
They are vicious. Seen the video of the dude getting into a fist fight with a kangaroo. But like, this is the nonsense that is this decarbonization movement and this NIMBYism that has left many countries exposed.
Yeah, I mean, that's a great point you bring up. So yes, I panic. I mean, look, my job is to think about the worst possible thing that could happen, and that's what I do. I wish I didn't always think about the worst possible thing. When it comes to the price of diesel or the price of gasoline, a lot of this domestically is built on the idea that in the future things are going to be figured out. And so our strategic oil reserves are the lowest they've ever been since probably like early 80s. So it's a problem. It's definitely a problem.
But hang on a second, because I hear people argue this. Reserves. But you're discounting the fact that the United States is the world's largest energy producer. So you're putting reserves because you need to put it into the pantry to store it because you may be net negative. But we produce so much energy here. So why is everybody panicked over the reserves when we actually produce the stuff here?
Yeah, so that's a great question. So when you talk about like things like oil and gas and things that are commodities, right? It's a global commodity. This is a commodity that is sold and used all across the world. So even though we might be a net exporter of this type of fuel, these hydrocarbons or whatever, the price is not dictated by the Americans. It's dictated by the global demand for it. So when you reduce the overall supply, the demand is going to either have to go down because you can't afford it, or you're going to have to find ways to keep it domestically. Now, this is the part that I think is fascinating. This is why the IEEPA conversation is so timely when you think about the conflict in Iran and the Strait of Hormuz. Now, IEEPA, you can't use it to raise revenue. You can't make tariffs. What you can do is you can ban imports. You can ban exports. There's no barrier that stops the president from doing something like that. So unless you say, as President Trump, I'm going to ban this exportation of the hydrocarbons and keep them domestically for my own supply, then that becomes probably a pathway. Now, that would presumably turn a lot of pressure on the global economy, but domestically we may be okay. On the strategic oil reserve part, now I am by no means an expert. I am simply a humble country lawyer. But one thing that's important to note is where this strategic oil reserve is located and how many millions and millions of barrels are inside there. There's a place where if you take too much out, the integrity of the structure of the cave system the stuff is stored in may start to fail. So there's a time that we see, I don't know the exact numbers, again, I'm not an expert, but it might be a couple months away of depletion to keep the prices somewhat consistent, where if you take enough out, you cannot take.
I think, look, we've covered oil, energy, we've had guests every single day. And as John Kingston, our oil reporter, likes to talk about, is diesel is priced at an equivalent, I think his number is like $140, $150 barrel because of the crack spread. And it's largely to do with the net shortage of diesel around the world. But like when you look at WTI at $82 a barrel and Brent's at $86 a barrel, that doesn't indicate stress. And you look at it on an inflation adjusted basis, we're not at any high pressure point. And yet the media, the broader media, not FreightWaves media, keep freaking out because they're afraid it's going to sap the consumer. And I say high oil prices at this level are good for the US economy. Everyone's panicked about it, but it's causing noise, but it's not worth getting upset about.
I think that, I may disagree then, because my feeling is, I think as of right now, I think the markets are pricing in that there will be some sort of resolution. I think they're assuming this will all work out. And I think we all can hope and we can all push our legislatures and push our representatives that this is what we want. The challenge we run into is that if there isn't a resolution, if this thing is protracted, and we all thought it'd be a couple of weeks and now it's several months, Congress has not weighed in. I mean, this is one of the really other big challenges we run into as Americans is the power to declare war has always sat with the legislature, but they seem to, again, once be asleep at the wheel or not willing to do their actual jobs we pay them for, to declare a war if we need to declare a war. But ultimately, if this thing continues, it will not be good for the American consumer.
I disagree, Matt. Completely disagree with you. Venezuela's coming on board. It was basically a non-participant in global oil markets. It's now a participant in providing U.S. oil. Canada is ramped up production. We're seeing investment in domestic sources. I think this whole thing is for naught unless you're, globally, there's a point. But, as we've covered frequently on the show, is the world is net flooded with fuel. Like we've learned that. The Chinese had an enormous amount of oil reserves. They've been selling it around the world because they weren't panicked. The idea that this, and look, we had a representative from the UAE on just a couple of days ago that talked about the fact that they are responding by building infrastructure. Saudi Arabia has opened up its pipeline. And yes, there's this bottleneck, but the world is working around the bottleneck. I just, again, go back to the fact that this is a narrative that is out there because people are very, very, Americans are generally against the war. And even the Republican Party, there's a whole faction of folks and portion of the Republican Party that hates forever wars. J.D. Vance is sort of the poster child of that, right? But the idea that this is going to sap the American economy has always been a misnomer. I've been on, every major cable news network talking about this. And when I get on these news networks, they're always surprised when I say that this conflict has driven more demand of the industrial sector because we happen to produce so much energy and the energy derivatives, petrochemicals, plastics, fertilizer. We produce that stuff in the United States. And the Americas, and I'm talking Canada, Mexico, Venezuela, Colombia, the United States, we are the only place in the world that you can get net energy without going through a conflict zone. Like, that is good for America. And do you think that the UAE and Saudi Arabia is not happy about this constraint? Absolutely. Why do you think they're rooting on the Trump administration to go after their enemy? It is, yes, they consider Iran a pariah. They have certainly orientated themselves to the Western economies and the United States specifically, this administration specifically. But don't you think they enjoy higher oil prices? It's in their interest to see that Iran is basically, isolated, if you will, and conflicted. There's a geopolitical element to that. But also, don't you think they enjoy higher oil prices? Don't you think that they enjoy this conflict because it drives up oil prices? Saudi Arabia's return on investment, they need something like $80 oil with all the CapEx, all these big projects that they've been spending. They need higher oil prices.
Yeah. I start with the American consumer. So if you go to an American consumer and say, I need $400, only about 40% of Americans could get you that money within 24 hours. So Americans don't have a lot of cash on hand. We've seen the credit card numbers go astronomically higher. The delinquencies are increasing, auto loan delinquencies, home foreclosures, and all these things. And like the pot is simmering. The pot is.
Oh, come on, Matt. That's such ridiculousness. Let me tell you why it's ridiculous. No, it is absolutely. You need to stop listening to these academic economists that don't actually look at the fact. The fact is that the average American consumer is spending $140 on food delivery, of which half of it is in fees.
Yeah,
$140 a month on food delivery. You add grocery delivery, and that number goes to $400 a month, half of which is fees and markup. And look, no, hang on a second. You've made your case. I want to make mine. The gasoline price increase in terms of where we were at prior to the war to where we're at today has impacted consumers by about $65 to $70 a month. If they were struggling, you know what they would do? Is they would cut off their food delivery. So how is this possibly going to impact the consumer negatively? I say BS on that.
The reality is there's a K-shaped recovery. There's a group of people who have no problem affording delivery of groceries or having restaurant food delivered, but there's also people who can't even go out and get food. They can't go to a restaurant. They can't afford that. Now, I'm not saying that's what everyone's experiencing, but when we look at the conflict in Iran, a war by choice that was never ratified by the American people, it has no accountability to our legislature's oversight with the use of the authorization of military force, which again is something I deeply, deeply find troubling. But when you have this buildup of this potential for diesel and gasoline to go to levels that we have not seen in a very—
But it never did. Inflicted that we were when missiles were flying and drones were blowing up Air Force bases. We were at $115 a barrel. Like, come on, man. This is not the crisis that everyone wanted it to be. It has been stimulant to the U.S. economy because those dollars, those Japanese yen, poured into the American economy. The Europeans started to buy their natural gas, increase their exports. This is not the crisis that everyone hoped it would be. Now, maybe it didn't work out the way the Trump administration wanted. Maybe it has been, from a sort of conflict resolution, we haven't got the outcome that we were all told we were going to get. Maybe this is not a justified war. I will give you all of that, and I would say that perhaps you need more congressional authority. Maybe the president thought this was going to be Venezuela 2.0, and he would just, do it. By the way, the U.S. military had an exceptionally good outcome. We haven't, in terms of like effectiveness, we haven't gotten to the results that we wanted. But I don't think anyone should be surprised if you look at, obviously the administration's surprised, but if you look at sort of the fact that the Iranians, their whole command structure has been wiped out. But the idea that it's going to sap the economy is such ridiculousness because nothing in the data. We saw the freight data heat up in March and April. We saw it in the industrial sector. We saw it in transportation demand. That is undisputed. And if any part of the economy was going to be sapped, it would be the stuff that we cover here at FreightWaves. Industrial goods, that's the stuff that is most impacted by the price of energy. Consumer retail goods, again, would be impacted if this were sapping consumer demand. Not happening. Retail sales were up 7%. So I keep hearing all of the, oh my God, the world's going to come to an end because of this war. It is not happening.
Well, it's interesting, retail sales being up, because that would actually just be how much people are spending is going.
No, you take out gasoline prices and you look at the total demand and you look at just the data. The containers into the port of LA, they just reported this. We've been reporting it here. The third biggest month in record. This is even beating the Liberation Day or not beating, but this is in concept of pre-stocking. There is no slowdown. We interview every single day on FreightWaves Today for the last 2 months. We have been interviewing people that have been in the freight economy, and what they consistently say is that the consumer is holding up, volumes are holding up, despite the noise. Commentators that don't know the freight economy are trying to interpret it because of their own biasness. We'll be right back to talk about this. Stay with us.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
Back to Freight Expectations. Matt, continuing this conversation, you know, the Trump administration this week, Donald Trump tweeted this or Truth posted it, I don't know. But,
they call it truth. He truthed it.
Truthed it, that he was going to do, he's the guardian of the Hormuz, and he's going to charge a 20% toll, on anybody that wanted to cross, any ship that wanted to cross the Hormuz. Now, this felt illegal to me. It didn't feel like there was any precedent. The ability for the administration to do that certainly didn't look like it was going to hold up. First of all, it didn't look legal. Second of all, it didn't look like it would ever hold up. And then there was a question about how do you even enforce this? Like, how is this paid? How do you enforce it? All those kinds of questions. Your take on this?
Well, so he did end up walking that back and saying he spoke with different members of the Middle East, different countries, and they said, we'd rather just invest money in the United States. So it sounds like that the 20% tolling or whatever it was characterized as is something he's likely not going to try to impose. But I think it's a reaction to what Iran was actually doing. So part of the memorandum of understanding was a pause of Iran to do any tolling over the next 60 days as they continue to negotiate. Now, the MOU is out the window, but that was part of the idea, was he was going to put together a pathway to toll these vessels. Iran is likely still doing that in certain cases, but I don't think the Americans are looking to do that. What I think is important here, and this is the part that I think is really important for all of our listeners and viewers to understand, is that the Americans, unfortunately, we're not able to guarantee safe passage in the straits. And the reality is one single drone or one single threat of a mine is enough for insurers to say those vessels are not going to go through. We're not going to allow it. And if we were going to put the tolling in place, the toll would have been to kind of guarantee safety, guarantee this stuff would make it to the destination. And we just simply can't do that. So as of right now, as far as I understand, Trump is no longer looking to have some sort of American tolling system. The Iranians, I believe, have done something like a 1% toll in some circumstances, so $15 million a pop if the vessel's large enough. But this just goes to show we are kind of dancing as the music continues to play. If everything stays status quo, I mean, 7 million barrels a day goes through the Saudis' oil pipeline to the Red Sea. But we've also seen recently the Iranians say they're going to encourage the Houthis to go into the Red Sea once again and try and do some damage on that trading route. So there's a lot of uncertainty. And if you lose one of these critical pieces of infrastructure, the production of these other countries becomes something that's in jeopardy. But it is interesting to watch everyone trying to clamor and say, hey, how can I make some money here? It'd be nice to be able to put a new toll in. Everybody wants to be the toll booth.
Well, I
There's
think
a lot of value there.
Covering Donald Trump, first of all, and I say this, I had a bunch of media outlets that reached out. Politico was one of them, to get a comment on his toll, the 20% toll that he threatened. Mm-hmm. And I said, look, and I've said this on national TV as well, I was like, look, you don't get excited. Trump says a lot of crazy stuff. Some of which he means at the moment, some of which he probably doesn't. Some of it's just posturing. But this is the way that this president decides to actually negotiate, we'll say, or the way he decides to communicate. In some ways, it's refreshing. In some ways, it's disturbing. I think, folks like you are more disturbed. I find it refreshing because it's like, it's kind of crazy. It's fun covering him because you just never know. And look, at some point, you're kind of like, we're all thinking it, and he's willing to say it. It's kind of fun. I think last year when he was talking about both, I think it was Iran and Israel, or no, it was the Palestinians and Israel. He both, basically said that they're both effed up. Which was kind of fun because we're all like, he's right, he's not wrong. It was interesting because he reversed course, I think within like 12 to 24 hours, that he was going to do this as a public service to these other countries, and it was going to do a blockade on Iranian traffic, which he does have the right to do that. And there was never a question about whether, as the commander-in-chief, whether he could actually go and use the military to exact some kind of a blockade or some type of enforcement. That was never really in question. The question is, what would you do with these tolls if you actually were able to collect them?
Yeah, I mean, the money would go somewhere. I mean, we're getting money from Venezuela now, so the money is coming through some different avenues, and where it ends up is it part of the budget.
Venezuela, I think we're getting money because it's coming to U.S. refiners. We're selling the oil through U.S. refiners, and then we're diverting that money back to Venezuela in terms of oil, and they've figured out some mechanism. I don't know what it is.
Yeah, and then the goal is to trade in American dollars. Yeah, a lot of it is just the goal is to trade everything in American dollars. That's an important part of our global hegemony on our currency structure. But yeah, I think on the tolling in the Strait of Hormuz, physically could it have been done? Certainly. But yeah, how would you collect the money? Would you wire transfer it? It'd be interesting. I'm glad he walked it back. Clearly, the other countries in the Middle East were not a big fan of that method. But man, this is for another 2 months, Craig. Like, what does this look like in 2 months from now? If this conflict is exactly as it is today, barring any catastrophic events on other infrastructure, if it's exactly as it is today, what do you think the impact for the American consumer would likely look like?
Nothing. I think it's going to be good. I don't think you have any negative impact. And the reason is because it's not going to be this catastrophic outcome. The world has oil reserves. We have plenty of oil reserves. What we don't have is refineries to refine the product. That's your problem. And that stuff is in the countries. That's the problem. There's so many proven oil reserves around the world that we can tap into. There's a lot of wells in West Texas that, because it was basically the return on investment, it costs too much to actually open those up, they're sitting. There's a lot of idle capacity out there. The good news is we've had 6 months now, and that is enough to drive investment cycle in some of the oil exploration. The world is still awash with oil. John Keeshan covers this often. And diesel and gasoline prices, that crack spread is indicating that oil should be a lot higher of a price. I don't think it has any impact on the consumer. And the thing you got to remember is that inflation, because everyone's sort of looking at the data from the 80s and 90s when we were a net importer of oil and energy as a percent of our economy was a much bigger piece than it is today. That's what everybody thinks is going to happen. And we've had many recessions that have been caused by high oil prices, but that was before the United States became the world's largest energy producer, which we are today. Where is the consumer going to get sapped, my friend?
I think I'm excited. I hope you're right. Like, look, I have been
so far about this issue. Everyone back in March said it was going to be the catastrophic outcome of the U.S. consumer and a catastrophic outcome to the economy. And my friend, it is growing. The economy is growing and inflation's coming down.
It'll be interesting to see how this plays out, because I think back in March when this conflict began, many people took the administration's word for what they meant, which was we're going to resolve this in a matter of weeks. And everyone kind of baked into the idea that we're going to take from reserves to keep the normal amounts available, not going to have a lot of crazy pricing. But if this thing continues, that's the part that I'm not sure about. So I hope that you're right. And I do hope that it gets resolved. That's my number one hope. But if it doesn't get resolved,
it's not going to be. It's just not going to be. The Iranians are using asymmetric warfare. The Houthi, we're firing missiles at container ships. They're not, like, at the end of the day, Iran is going to continue this conflict because that enables them to stay in power. It's the same reason that Putin, there's too much money on the line for the Iranians. They're not going to give this up. But this is going to be a permanent fixture of the Middle East. They're not going to resolve this anytime soon. It's not going to impact the U.S. consumer.
I'm glad that our kids can grow up with a forever war like you and I did, because it was nice.
But the difference is there are not troops on the ground, and I don't think there's anyone going to suggest that the administration is going to put troops on the ground.
That's the big question. You're exactly right. I mean, the Israelis really do want us to put boots on the ground. J.D. Vance, in his recent interview with Joe Rogan, said there is no plans, or there's no plans to put boots on the ground. Trump has kept that open. He hasn't said he's definitely not going to do it, but I think you're right. But if time and circumstances change, fog of war is fog of war.
They are effectively, other than firing some missiles and drones at ships passing and putting mines out there, they're not able to inflict any real damage on their neighbors. Like, they're throwing a missile at Kuwait. There are missiles, but business has largely resumed, and the countries that are being attacked are all in on continuing to fight them. The United States is not feeling the pain, and the U.S. economy is not going to feel the pain. And look, you can look at the industrial rail volume data. We've seen an expansion of economic activity since the war started, not a contraction. And consumers are holding up. Consumers are buying cars. We talked about that earlier in the segment, is that car purchases are increasing. Inflation's coming down, which could lower interest rates. I think that's been the question. If there has been a drag on the U.S. economy other than energy itself, it has been higher interest rates, because the 10-year kind of went berserk when the wars first started. It reversed course. That has been the big impact, is it may have impacted housing purchases and auto purchases. But autos, it seems like we're getting on with buying autos.
Yeah, I mean, what the Trump administration has asked from Congress is essentially to double the budget for the Pentagon. So from $800 billion to $1.6 trillion, I believe, for next year. We'll see how that goes. So there will ultimately be a cost. Like, these things aren't free to go sending off on adventures across the world. I hope that you're right. I mean,
85%. By the way, in the new Defense Department bill, the Department of War bill, the budget that's being considered, it would take us to 1.5 $1.5 trillion, up from it. Actually, it's $960 billion is my read. We did a sit rep, which is a white paper on this. The interesting thing about that number is that 85% of the increase in the budget is in something called procurement. It is weapons and munitions. It's not in the troops are going to get a 7% pay increase because that's how you get a defense department. The way you get these big bills made in the American military industrial complex is you make sure that you distribute your supply chains across every district.
So no one votes against you. Absolutely.
And then you increase the pay for the troops. And guess what? You get your bill passed. It will probably pass. The interesting thing is $1.5 trillion would be the largest, and you mentioned it's a 50% increase over this past year of a 2026 bill. If you go back to 2025's bill, it's like 800, the number that you mentioned. It's almost double from where we were, just shows you the rate of increase. But the interesting thing about it at 1.5 trillion is it's still in very similar percentages of our GDP. So that $1.5 trillion, when you have a $30+ trillion economy, it's only like 5% of our economy, which is keeping with historic norms and sort of the Cold War norms of military spending. So it's not a massive number, but the idea is really topping up weapons, your cruise missiles, your Patriot weapons, your Abrams tanks, your airplanes, a lot of these autonomous drones. One of the other groups that they topped off, by the way, I am officially a middle-aged dad because I spend my weekends watching YouTube videos of wars and military stuff. That is when when you smoke meat, you watch birds, and you watch military YouTube videos. I have reached middle-aged dadhood. That's what I do on the weekends, all three. What's interesting is they have created a new division, a new department for a new branch of the military. It's called DAWG, D-A-W-G. It's a very Trump 2.0 administration name. DAWG is basically anti-drone warfare because what they've realized watching Ukraine. Yes. And then you could also argue that Iran is the same thing, is this asymmetric warfare that's taking place, this guerrilla warfare through drones, is how it will be fought in the future. The problem is if you're a superpower and you've been investing in the F-35 and the F-22s and the V-2 bombers, that's great, except when you have a country like Iran or Ukraine that can spend $100 on a drone or $10,000 on one of these autonomous UAV weapons, is you can't fight the war with a B-2 bomber if your enemy, you can, but you obliterate them, but you can't solve these small arms fires. That's what the U.S. is trying to do. I'm trying to build basically a defense system to fight drone warfare and UAV warfare, and that's what is $50 billion, which would make it the 10th largest, if it were a branch of a military, of a country, it would be the 10th largest military spending in the world. It would be number 10.
It's fascinating because it's talk about military history and being a middle-aged man. I'm 41 and I got 4 kids.
By the way, YouTube's got some fantastic videos. Pick your war. I like the modern sort of post-Cold War stuff.
I love World War I. That's my favorite war to follow.
A very interesting time.
I mean, like the Ottoman Empire, man, like all the problems in the Middle East, just go back to World War I. But to talk about this question you have about the drone warfare. In World War II, everyone went to the Navy. They all thought about destroyers. They weren't thinking aircraft carriers were the new platform that would be the real way to wage modern conflicts. And once we realized that aircraft carriers were as valuable as they were, the Americans were so much better equipped to build these and deploy these, they were able to go from Midway on and just kind of decimate the Japanese naval forces. But what we're seeing now, to your point, wars are being fought differently now. Of course, there's cyber warfare, there's still conventional arms, but the use of drones, especially in that Russian-Ukrainian conflict, you can see these things every single day on YouTube or Reddit or wherever else on combat footage, how people wage war in a modern setting. And to your point, it is very asymmetrical. You could spend $50 million on a particular device or platform and have it completely destroyed for less than $1,000 with an equipped drone that has a little bomb on it. And that's what's made this whole conflict in Iran so interesting, because ultimately we are watching major military powers. The greatest military that's ever existed in the history of the world is the U.S. military. And we're combating and trying to protect our allies as tiny little drones are flying in and causing very big damage. And so it makes sense to invest in this kind of anti-drone warfare, because presumably drone warfare is how it's going to be fought for a very, very long time. They're not going to likely have a lot of human beings out in harm's way as much as you're going to have autonomous platforms seeking to destroy people with a remote operator half a world away.
No, it's really interesting, Matt. I mean, the Japanese, the Zero, which was the Japanese airframe that came to Pearl Harbor and woke up America, was really sort of the first major pivot in that. I mean, it was for America, it certainly was our wake-up call. It was the only pivot, because we were introduced to the Zero flying over Pearl Harbor. But to your point, that became an air war. And we produced 300,000 airplanes over the 4-year period. America was not ready for that war. America was not prepared for World War II until we became prepared. The reason we became prepared was because of our industrial supply chain. And auto manufacturers specifically pivoted from producing cars to producing airplanes. And that was the reason we produced 300,000 airplanes. That is more airplanes than we have flying currently today, just over that 4-year period. They were producing these aircraft, and that is what drone warfare effectively is. Now, here's the issue, and here's the reason that I'm excited that we have a $1.5 trillion defense budget. Because we are not ready to fight a war against China. China has all of the advantages in supply chain. They can produce the drones at mass and fast, and they do. The United States is not prepared because we do not have the industrial manufacturing infrastructure today to actually fight a war with China. They will outlast us, and supply chains win wars. We've covered extensively. That was ultimately what cost the Japanese World War II. The Pacific Rim is they ran out of resources. They were exploiting the resources of China. They ran out of rubber. They ran out of oil. They ran out of, because their whole business model or their economic model was a very mercantile, just sort of a version of colonialism. The Japanese track record in World War II was, or pre-World War II in the 1930s, abysmal human rights violations. Just what they did in China and throughout Asia. Knowing the Japanese today and visiting there, and these are very polite, honorable people, they deserve a lot of the critique of how they treated their neighbors in Asia. Just horrible, horrible human rights violations. But having said that, the reason that the United States was able to fend off, because they had the fighting spirit, the Japanese did. They believed they were doing this by sort of the order of God, or this emperor that was godlike was doing it for, they truly believed that they were in the right, was because of a supply chain. They didn't have the oil, they didn't have the rubber, they didn't have the resources to fight that war. With China, they have the resources. The United States could have the resources if we had the manufacturing capacity. We need these small military conflicts that we have in Iran. You could argue that what we're seeing in Ukraine is forcing our hand to go build the manufacturing supply chain to fight the war. There's a new shipyard. I don't know if you call it this, but California lost a $3 billion shipyard for military purposes that's going to be built in South Texas because California screwed around and California'd it, and those founders moved to Texas to build these autonomous ships.
Yeah, the biggest export from California is California businesses. They're going all over the country to get out of the People's Republic of California. But I think your point's really well taken, Craig. We in America we have a big military industrial complex. We can turn domestic manufacturers into manufacturers for instruments of war whenever we need to or want to. That's part of the reason we have the kind of government structure we do, is that when we need to turn on our domestic manufacturing capabilities for war, we can do that. I think the increase in the defense spending, it makes sense given we've spent a lot of munitions fairly recently. We need to replenish those reserves. And war is changing. And if we want to be the dominant military in the world, there's not many other ways to do it other than investing in our Pentagon.
What we did in the Iran conflict for the 6 weeks we were at war, whatever it was, 8 years of cruise missiles like we deployed there. And that's what it will take in terms of the current stock. So we need the catalyst. If you're going to win a war against an adversary like China, which has an almost endless supply chain, You got to get ready. If nothing else, it's a war you don't want to fight.
China.
It's a war you don't want to fight. But the best way to not fight a war is to do the Sun Tzu thing, which is make sure that you're ready and your enemy knows that you're ready. And that's how you end up making sure that there isn't a conflict. With that, Matt, always enjoy Fridays. It's my favorite day of the week because we get to talk about freight expectations. We'll be back here next week and every day.
Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain